Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On tonight's program, we just have to look into this current sell-off of stocks, both on Wall Street and here right around the world. Anxiety about artificial intelligence, or is it something else? Is it the fear of no rate cuts in the US? Is it the shutdown and the lack of data? All this is sort of got together at a time when earnings are really, really good in the US, but valuations are very, very high. So a lot of this is understandable. So the big question is, are we talking about a pullback, a correction, that means a drop 10% or more, or a crash 20% or more? That's the kind of thing I want to talk to about with my two guests, Raymond Chan of Morgans and Jun Bei Liu of TenCap. Let's kick off with Jun Bei Liu from TenCap and just see what she's thinking about right now. And we'll also do a bit of speed dating with Jun Bei Liu and with Raymond Chan about the stocks I like, and I want to see if they like them as well. Jun Bei Liu, thanks for joining us.
Thank you for having me, Peter. I always love to talk about share market.
Yeah, I know. Is there anything else you ever talk about? You ever go out with friends or family? Do you ever talk about anything else?
We talk about stocks. What do you think the dinner table conversation is? Even my kids now into it.
Yeah. You might talk about Harper's Bazaar magazine because you do like good
Oh, I
players.
love those ones. That's right. Absolutely. My kids love them. I got lots of at her bedside table.
Okay. Now, the big question everyone would like to hear your answer to is, okay, we've seen some concerns out of Wall Street around artificial intelligence. First question, do you think there's an artificial intelligence bubble?
I don't think there is an artificial intelligence bubble. Some areas there might be some issues, but I do think it's broadening out. We all using it, and the user case is getting more and more and more, not narrow. So I think that the real application means the valuation might be a bit high, but it's going to meet the earnings is going to grow so exponentially.
Right. Next question. Are we looking at a pullback, a correction, or a crash right now? I'm asking the question objectively. I know that there's two of them you're going to reject. So is it a pullback, a correction, or a crash?
Look, it's a pullback. It's people just taking a bit of profit in the stuff that they make so much money in, and then looking for reasons. All these companies have great earnings, and then they go, you know what? Let's take some money off the table. I really believe it's a healthy pullback, and reposition us into this December rally.
Yeah. Is it all artificial anxiety, or is it interest rate concerns? Is it overvaluation opportunity, or, taking profit opportunities? What else? Anything else?
Oh no, I think it's just a bit of everything. Everything that you said, the people just looking for a reason to take profit in the big, growth companies, regardless of their results and other things. So there's really nothing wrong in those businesses. Just the sentiment, just taking a bit of consolidation, if you like.
Okay, now I'm going to ask you a really hard question. Really hard question. I bet you're positive for stocks on 2026. Is that a fair assumption?
Yeah, of course. It's not an assumption. It should be a high probability.
Okay, all right.
I think very high probability it would do
All right.
well.
But all right. But and I know the second year of a US presidency is not really good for Wall Street. In fact, I noticed that the historical drawdown is 17%. So the question is, what is there in this Donald Trump regime in the second year of his presidency that might break with the historical trend?
Yeah, I really think it's the next step is the financial. There's a few things in the pipe, but the big one is the financial deregulation, right? So they already have most of the regulators stepping back in the pressure they have on the financial sector. Hence why we see all the banks in the US delivering all-time high results. Now, 2026 is going to be even stronger. And once they pull off the regulation to let them reduce the capital requirement, that is going to be used to put it back into the market. It's not going to be used to buy back their own shares. No, it's going to be used towards deals and activity. That means it's going to keep the market very buoyant.
Okay, so what you're saying is, I basically, if you're the witness, I have led the witness because as an economic historian, I do respect the fact that the second year of a US presidency can be bad for the market, but this guy is unusual. He's got the one big beautiful bill that should be good for stocks. He's got financial deregulation, as you pointed out, that should be good for stocks, provided there's not a serious problem with the data that comes out of the shutdown period. I kind of think 2026 should be okay for stocks. Is there anything I'm missing?
You didn't miss anything. I think 2026 is going to be great for stocks. Aside from there's still more interest rate cut to come in the US with the relaxation, and then you've got Trump will do anything to get his popularity up. All of that combined, I do think that next year actually it looks good.
Yeah, if we're right that 2026 doesn't follow the historical pattern, I guess 2027 could be challenging because it's
That's
a long
way far away.
I know.
Of course, we're going to be right. 23.
You're not a long-term person. Okay, now I had Raymond Chan on earlier, and we did speed dating, so we're going to do speed dating with you. Okay,
Sure.
these are stocks that have copped it lately. Do you think they've got good term, long-term upside? Not short-term, because short-term is trickier. CSL, long-term upside, yes or no?
Neutral.
Neutral.
That
Okay.
was very hard.
Yeah, controversial.
Losing share. Yeah.
What's the one concern you've got about CSL for you to say neutral? That's nearly like a crime against Jun Bei Liu to say neutral, but go on.
Oh, look, I just think that I'm actually not sure what's their mojo is. That they've been losing share to their competitors, and they're blaming everything else but themselves. So I want to understand why is that. For a growth company that's losing share, that's not growing as it should be, I don't know what's going to make it become the quality company again they used to be. So perhaps it's more evidence. Perhaps they were right. It was a one-off issues, but they certainly did not communicate. And so after so many downgrades, it has led me to believe maybe culturally there's something wrong with it.
And so what you really say, you're not going to risk your money on CSL at this point in time. You could change your mind. When you do, make sure you tell us.
That's right.
Okay. Goodman Group.
You'll be the first one. Goodman Group,
Goodman Group.
that's a buy. Yeah, Goodman Group is a buy. It got caught out in all these expensive company being sold of AI and the like. If you want to actually make money from out of a data center, this is the one that actually have real clients, real pipeline, and everything else. So it looks very cheap.
Pro Medicus.
That's a buy. The company's off a
So
lot.
you see her eyes swell up? That's a real good buy. Go on.
If you look at all the earnings that they just won another contract today, and in fact, they just pretty much covered what they're going to earn next year. This is the highest quality company you can find in this market. It's expensive, I know, but it's come off a lot. It's just hard to find growth companies here in Australia.
Next one, Zero.
Zero is a little bit wait and see. I think I'm warming up to it now because the result, I have to say, is a little bit disappointing where they met expectations on capitalizing more earnings. I would say most analysts put on the buy. I'm more of a soft buy, if you like. I don't feel strongly about it. They've got this new company, Melio, they just bought, very expensive, still loss making, spent $4 billion on it. It just seems to be there's a lot of messy components going on. Probably I need a bit more clarity. I'm more of a soft buy.
Okay. All right. 360, Life 360.
Yeah, that's a buy. This company has delivered earnings upgrades, ticked every box, and then people looking for a reason to sell it. That's a buy.
Now, we've seen lithium get hotter. Is PLS, Pilbara, a buy?
Yeah. PLS is a buy. So lithium prices really turned the corner now, even though, look, we still have some of the large lithium mine coming back online. So normally they create a bit of disruption, people get a shock and so much supply. But the demand for the energy storage solution, the battery and the like around the world is picking up massively off the low base, but that seems to be soaking up some of the demand weaknesses for this lithium. So I actually think that looks really, really interesting. Same as mineral resources and others.
Yeah, I took that POSCO buying a big chunk of mineral resources as a big company saying, yeah, lithium's not going away.
That's right, absolutely. I do think the corporates, they know what they need to the future commodities.
Yeah. All right, Drone Shield.
Yeah, that one's hard. I think I almost fear there might be some sort of ASIC investigation on that front. It's I remember I was investing in this one maybe a year and a half ago. And then we sort of took profit, made money, and then we more recently had this massive rally. We just felt it was too hot. And now that with them, they announce a contract, then bring it back, retrace the contract, and then everybody, directors and company CEOs sold all their shares there is to sell. At the same time, when they announce the fake contract, it just feels there's something that it will lead to a lot of investigation, which is normally not great for share price, especially for the speculative ones.
Yeah, I guess I am dealing with the tricky founder issue. Wise Tech.
Yeah, that one's actually quite hard. It looks quite cheap, looks very cheap. And I truly believe this business is incredible. The new pricing strategy they just adopted a month ago actually will generate significant earnings uplift, which we won't see in the first half. It will be in the second half. I think the challenge is that, would there be any more news headline? But I will probably put it here as a speculative buy here. It looks very, very, looks very cheap.
Yeah, and on the drone shield one, it's all allegations. It's not that nothing you said was actually categorical.
No, it's not. Yeah,
It's just a thought. There's a reports, and there's question marks over it. That's all. But it's all allegations. That's nothing certain about that. And we'll finish up on mineral resources because that was an interesting one. Is it still a buy, or has it really because of the POSCO purchase and we've seen the share price rise, is there more upside, do you think?
Yeah, even though the share price has gone up a lot, it actually still looked very cheap. And then how quickly it's deleveraging, it's quite incredible. Now, again, this one's got ASIC investigation going on. So, you probably put on the speculative buy. But given both of its commodity are doing really well and it's leveraged, so in the in the environment where both earnings are going higher, the commodity are going higher, this company's earning will be so leveraged, so sensitive, and so the upgrade will be enormous in the next 12 months, should these trend continue. So I'll put that one on the spec buy, probably not a huge position because of the ASIC investigation.
Okay, now you've also got a new fund. With the name TCAP. Is it TCAP?
That's right, TCAP.
Okay.
It's actually the same fund, but with a new ETF.
All right. So it's like all the big ideas of JBL in the fund called TenCap, but you pull like an ETF out of that. So if TenCap goes up by 10%, TCAP should go by 10%, right?
Absolutely.
Okay. So it's an exchange traded fund.
Yeah, it is an exchange traded fund. It's one of those new thing. It's the active ETF. So it gives you direct link to my fund, like you said. And the first time ever you have access to Australian long short manager. So we're very excited to be the one of the first. And then with the starting dollar, only $10. Remove the investing friction. And for a fund that's been around, our fund's been around 20 years. It's an institutional grade fund, and now investor has the access to it.
Okay, so if they went on to say ComSec or NAB Trade, they would see TCAP there.
That's right, from 24th, Monday next week.
Next week, okay. All right, and you do love 10, don't you? Everything you've got is 10.
That's right, start from $10.
All right, okay. One last thing. What is the one new idea that has resulted in you adding something to your fund? What's the latest one?
The latest new idea, I think I'm trying to think through. I think one of the latest idea that I added more to it is JB Hi-Fi. I think share price has come off a lot, and it was very expensive, but I think you're heading into, especially a lot of discretionary companies, are heading into a bigger sale period, which is November. Consumer electronics is big components in that whole cyber weekend, which is latter part of this month. I think will track very well on the way up.
Yeah, despite the fact there's not going to be as many rate cuts, part of its fall has been linked to that, hasn't it? When we thought there might be 2 or 3 cuts, it might only be one, it might be none. So you're gambling that the rate cut story is probably an exaggeration to the negative that needed to be.
Yeah, that's right. So consumer is actually strong. If you look at the furniture spend actually being strong, if you look at the online spend, most of discretionary retailer has had a great October actually. So we're actually tracking into a good environment. And then the sales period, if you look at the retailers, not many of them started earlier than last year, which is a good sign because if they did, it means things a bit desperate, but they didn't. So, JB still starting a similar time and most of people have, and Temple Webster, similar sort of time. So, it's actually looking pretty strong heading into this environment. And I think if you look at the reasons is RBA is not cutting, consumers are actually okay. They're actually doing pretty well. But they like discounts. If you have discount, they'll wait for it and then they will spend.
Yeah, consumer sentiment rose last week, didn't it? And Nick Scali reported very well too. So
Absolutely, absolutely. You got to stay with winners. So, I think it's there's a good chance to pick up some of those names heading into Christmas.
great stuff. Jun Bei Liu, as always, great to talk to you.
Thank you so much for having me, Peter.
And that was Jun Bei Liu of TenCap. Now let's catch up with Raymond Chan of Morgans. Thanks for joining us, Raymond.
Thanks, Peter. Thanks for having me.
Now, I'm not sure whether my producer Luke has got this right, but he seemed to want this program to look at the optimistic view and the pessimistic view of what might happen to the market. Now, Jun Bei Liu's coming on the show, and she can't help but being optimistic because some of our viewers have actually christened her Jun Bei Liu. Yeah, Jun Bei Liu. And but I was seeing you as more a measured expert on the market. Sometimes you'll be negative, sometimes you'll be positive. So, what is your current state? Are you a little bit negative about the market right now?
I think the first thing we look at is why there's a talk about market pullback. I guess the biggest theme for 2025, besides AI, has been the central bank easing. So that theme seems to have changed over the past 2 months. First of all, we have the Reserve Bank pause rate cut on the Melbourne Cup Day. Now market only have a less than, more like 50-50 percent chance for another rate cut next year. So that's another year's story. And the ECB has been on pause for quite a few months. And lately, the Federal Reserve, now the odd for the Federal Reserve rate cut has been reduced from 95% just a month ago to today, just 44%. So this is telling me the easing, which is the second biggest theme for 2025 market gain, has been coming toward the end rather than the beginning. So that certainly triggered a bit of profit taking in the market. And remember, like since the beginning of the calendar year, many of the market has performed really, really well. We look at, the Max 7 stocks still up around 19%. The emerging market is the bright spot, up close to 30%. And our mighty ASX 200, up, a bit over 7% year to date. So with a bit of, gain year to date, investors are right to question whether this gain is sustainable. And there's some talk about some funds manager may want to lock in a gain before the end of financial year rather than chasing the standard cost rally. So that, I think, Peter, is the negative point about the market at the moment, and that trigger a bit of softness. I wouldn't say it's sell off, a bit of softness from recent high.
Okay, now let me put you on the spot, Raymond. Do you think there is an artificial intelligence bubble?
That's a very good question, Peter. Normally, we will notice there's a bubble after the bubble bursted. So the way we look at it is, I recall during tech wreck, that was, I guess, my early days when I was in the market. I joined the industry in 1998. At that time, everyone just tell me about, at that time they got a TMT, right, sector. Now, at that time, the biggest talk of in town is Cisco back then, and now, of course, it's a different thing. But I want to reflect on that tech wreck to today's AI theme is somewhat different, because in that time there's a lot of these investment being funded by equity raising, and more importantly, debt raising. A lot of these fiber optics company like PowerTel, they have, a bit of, high level of debt back then. However, this time the AI boom is pretty much funded by the cash flow from the company. So that make it more sustainable. Then the question is about the valuation. I think eventually some part of the AI-driven investment may turn out to be less profitable or even lose money for the investor. But whether, this is the peak, as I say, the bubble can only be tell after it's bursted. Investor, of course, should stay limbo, because we all know the valuation is elevated at the moment.
Yeah. Well, I should say to normal people who are listening, Raymond, listening to a man of the markets talk at length and in a very articulate way about what's going on. What Raymond really said was, no, he doesn't think it's a bubble. He thinks there's probably overvaluation of some companies, but he probably believes that artificial intelligence is going to be fairly important to lots of companies. And he also made the point, sorry to be interpreting you, Raymond, but some people are normal out there. What you're saying, the tech wreck, there are a lot of crap companies that we're building up. These are the cream of the crop companies in the US, and they're not the cream of the crap. And that's the reason why this is probably not a bubble at this point in time. Good analysis, Raymond. Let's go to your view on at what point of this pullback would you say, okay, buy zone time? What percent? 10%? 8%?
Yeah, very good question to ask. I think, we look at the fair value of the market, as always. At the moment, it's fair to say the fair value is closer to 8,000 points than where we are, over 8,600 points. So if we get closer to 8,000 points, it's a screaming buy. Whether the market will go down to this level, we do not know. But with the fair value, the way we look at it is when the market is trading above the fair value, which is around the 8,000 points, we tend to be a little bit more cautious. If it drop below the 8,000 point, I think, is a screaming buy, then, we will just go in and invest for long term. But one thing for the viewer to understand, the fair value of the market will change. And that what make the earning outlook become very important for the investor. So yes, we can look at some of the stocks that trade, say, Commonwealth Bank, this trade up to $190. It dropped to $155. Does it mean that become a cheaper stock to buy? Maybe yes, maybe no. We have to look at the earning outlook. We know the banks will grow by about 3%, and they're still trading at quite elevated valuation. However, when we look at the earning outlook for the market as a backdrop, we look at FY26 earnings. So, i.e., this financial year, the whole market expect earning growth of around 5.7%, and the following financial year, which is a FY27, the market is looking for an earning growth of 7.3%. So what it means is the fair value will increase from currently around 8,000 points to a higher level. How high can it be? It depends on our earnings. However, if we always buy near the fair value, I think, that certainly be a long-term strategies. Do I stay invested in the current market? Yes, I think we should always stay invested in the market, but keep some powder dry just in case, if there's a deeper correction, so that we can pick up some good stock that we always love to buy.
Yeah. I've got to say, with our financial planning clients, as cash came available, I've actually kept on the sideline for exactly that reason. There's going to be a pullback. There'll be a buying opportunity. And I'm thinking, Raymond, are we being driven more by what's going on in the US or more by what's going on here in the Australian economy?
Yeah, I think a bit of both. The AI will certainly have more impact to the technology side of our market. That's why we saw a bit of pullback from, previous high flyer. A Goodman is a good example. Yes, the management didn't upgrade the earnings, and the market interpret as a downgrade already, because the markets get used to an upgrade of earning guidance along the year. Now, the other thing we look at is locally. Locally, there's a lot of concentration about the interest rate outlook. Yes, the 10-year bond yield has ticked up from quite a low level. Of course, not as low as during the COVID time, but still ticking up. That already quickly triggered a bit of sell off in the long duration assets, i.e., the infrastructure stocks as well as the property sector. So those two of the sector, quite interestingly, the pullback will create opportunity for investor, because some of the infrastructure company, they in fact are CPI link. So a bit of pullback will allow us to pick up those stocks on a high yield. So I think, yes, locally that there's some factor impacting the market. However, those are the factors which I think will be short term. When the time passes, the market will digest, the interest rate cycle. They will look back to the earnings, and those quality company will again outperform in future.
Okay, let's just do some speed dating now, Raymond. Do you like these stocks? Do you like these stocks? And these ones have been sold off, and these ones I like. CSL, do we buy them now or do we wait?
I think we have a buy on CSL. I think at the current level, the downside risk is limited. Yes, we certainly see some of the division of CSL, especially the vaccine division, being challenged. But I got to my review at one stage, the vaccine division used to be 30% of the revenue. Now it's more like 15% of the revenue. The key part is now the plasma driven drugs division, which is almost 70% of the total revenue. That we think we will continue to grow quite well. At the moment, they're trading at a PE which is at a discount to the long-term average. We don't think there's too much of the downside risk for CSL at this stage. So for us, it's a buy.
Next one, Zero.
Okay, Zero is a little bit interesting. Remember, Zero is a growth company. When they make the acquisition about with aim to expand into the US market, we want them to expand it into the US market. What it means is they're likely to be short-term pain before long-term gain. What I mean by that is with the business they acquire, the business itself is we suck up the cash flow, and that result in the endless downgrade. So for those investors who first of all look for the income type of investment, Zero certainly not for them. But for the growth investor, we just have to be mindful. It will probably take some time before Zero can deliver to their long-term plan, which I think is important for them. So for us, I think at this stage, we will have a whole recommendation on Zero.
Yeah, next DC.
Next DC is an interesting one. Some people really love it. Some people really hate it. So next DC at the current price, they certainly not cheap. But the company have a strong track record of growing data center, and now obviously they changed the model a little bit for good. What I mean by that is they're now partnering with capital partner to develop the offshore area such as Japan, which I think will deliver a good return for them. Now, how do we evaluate data center? Remember, data center tend to trade in a basket. So the thing about data center is if the sentiment move toward data center again, such as a very good result come out from NVIDIA later on this week, we may see a bounce on data center. But at the moment, next DC is likely to trade sideways before a more clear direction in terms of where we go in terms of the AI. So it's not a screaming buy at the moment, but further weakness likely to create opportunity.
Okay, what about Goodman Group? You did refer to it. Do you put the same kind of answer as you gave me for next DC?
Quite the otherwise. Goodman, I actually like this name at the current price. The reason I refer to that is because Goodman on the headline, the gearing is very low, is a high single digit. So I think Goodman can withstand the market volatility a little bit better. Also, the stocks has meaningfully pulled back from its recent high. Yes, it's below its placement price, and that would certainly hurt a few people, and the sentiment continue to be bad. I think what we need for Goodman is in the next set of update, they start to upgrade the outlook a little bit, and the market will start to love Goodman again. So I think the current pullback will likely to be a buying opportunity for Goodman, especially is below $30.
360. 360.
360 is an interesting one. We don't have a coverage on the company, but my dog is using it. We use it to track where it's going. So then,
Dog.
yeah. This is one of the big features for 360.
I reckon it's a winner. People love their dogs. Good point.
Yeah. So we don't unfortunately have a coverage on
Okay.
the company.
But what's the gut feel from the very experienced Raymond Chan? Or not?
I'm unable to claim as an expert in the area, but we think there's a play certainly.
Yeah, I'm going with Raymond Chan's dog on this one. One final one, mate, is Pro Medicus. Seeing it at a much lower price. Is it a go at these prices?
Our analysts always like this company. We think the growth certainly meaningfully in US. They have a market share in US, and those contracts are very sticky. That's what we like. But of course, on the flip side of it, once the contract expires, they need to go on the public tender to bid for another extension of the contract. We like this company. That it is certainly worth look at. If there's price weakness on Pro Medicus in the current market.
Yeah. Okay. And the last and most important question: what is the name of your dog, Raymond?
Well, it's funny enough. It's in a Chinese name. It's called Little White, but I have to translate that into Chinese.
Okay. So Little White. Okay.
Little White, yes.
Okay, we'll have to start talking about the little white tip. All right, mate, great. Thanks for joining us.
Thank you.
And that was Raymond Chan of Morgans. Thanks for joining us. That's the show for tonight. Remember, if you want to get my ideas daily, you got to go to Switzer Daily, switzer.com.au. Or if you want more in-depth analysis about what's going on in the stock market and get some forecasts and tips from very, very insightful experts on the market, you're going to have to become a subscriber to the Switzer Report. Go to switzerreport.com.au. Thanks for joining us. I'll see you next week.